Good morning. I think we are live. Jackie, are we live? I believe so. Good morning, everyone. This is Jeremy Martin, Vice President for Energy and Sustainability at the Institute of the Americas. And welcome to our Madrid Energy Conference Curtain Raiser webinar. Today we officially kicked off the Madrid Energy Conference, the virtual edition this year, a few weeks ago, probably a few months ago. But today we're going to continue to talk about and raise the curtain on some of the issues we'll get into in much greater detail during the course of the Madrid Energy Conference, which, for those of you who have not taken note, is set for September 28th through October 2nd. So at the end of the month, beginning of October. And we invite everyone who has not registered yet or reviewed the information to check out the Institute of the Americas website and go to the Madrid Energy Conference and take a look at this amazing lineup of speakers and topics where Europe and Latin America meet for energy dialogue. That's been the goal since we launched the Madrid Energy Conference last year with our partners IPD Latin America and Global Event Partners. And the idea is really to try and bridge the policy and energy transition debate between Europe and Latin America. What's happening in the policy front, what's happening in technology and development, what's happening in key segments of the different energy sectors. And so with that said, today we'll focus on natural gas as well as liquefied natural gas. And as I mentioned, this is a curtain raiser. The idea is to tease up or dig a little bit deeper into some of the questions that Chris Gonçalves from BRG, the Energy and Climate Practice, will join us discussing in the panel on October 1st. And we also have from his team, Roberto Cunha, who's joining us live from Rio. Chris is joining us from Washington, D.C. And I want to thank Chris and his team and BRG for their support as a sponsor of the Madrid Energy Conference. And as I mentioned, Chris is going to get into this question we have set for the panel: does natural gas remain the transition fuel? And so the idea of the Madrid Energy Conference is to really have a high-level policy, investment, COVID context, green, not so green recovery debate. And so within that, where does natural gas fit? We've talked for years, and there's been a pretty strong debate over the role of natural gas in the energy transition. Obviously power generation, but there's been a lot of discussion and even some reporting lately about what companies view in terms of methane and emissions reduction when it comes to touting natural gas as a transition fuel. Regional integration is huge in Latin America on the back of natural gas. Power generation, maybe even transport in certain marketplaces, it's a key element, and liquefied natural gas. And so let me invite Chris to kick off his remarks and presentation. We've got just about 40 minutes, 45 minutes for Chris and Roberto. They'll share the presentation. And just a reminder for those of you who've not joined us in one of our webinars before, you don't have to wait to pose questions until the Q&A period. That is to say, we've got the chat function there. I just wrote the word question. If there's something Chris notes, if there's something Roberto mentions that you want to make sure you question or throw out a comment or just want us to come back to, please post that in the chat and we'll get to that during the live Q&A discussion period with those two. So liquefied natural gas in South America. There's a lot to cover, so let me stop there and formally raise the curtain with the Curtain Raiser webinar and turn it over to my good friend and longtime colleague, Chris Gonçalves at BRG. Chris, thanks so much for your support and joining us.
Thank you, Jeremy. Good to be here. Good to be back involved with your organization. We've done many things together over the years, and I'm very excited to participate this year in the Madrid Energy Conference. It's also very nice to see on the list of attendees a lot of familiar names from a variety of work over and conferences over years past. So very good to be here. I like this theme a lot, and also very happy also to have my colleague Roberto Cunha, who's just joined us in 2020, perhaps with arguably inauspicious timing, although it's actually going very well for him and for us in Rio de Janeiro in Brazil. So we've now got our practice up and running in South America as well. I'm very happy to be here discussing this topic with you. For those who know me personally, and Jeremy in particular probably knows, I started in the natural gas business in the early 1990s, really because I saw natural gas as a bridge fuel for the energy transition. And at the time, renewable energy and clean energy were not really viable solutions. They were extremely expensive, very small scale. I remember talking about wind turbines measured in kilowatts of capacity, not megawatts of capacity. Solar was probably 10 times more expensive than gas-fired power, and things of that nature. So look how far we've come in the course of my career so far over the last 26, 27 years, whatever it's been. Actually, probably getting closer to 30, but who's counting? At any rate, and I find myself asking, and actually I'm working with a colleague right now on an article about the role of of natural gas in the energy transition as a bridge fuel. Are we at the end of the bridge? Are we just barely to the middle of the bridge? Or are we about to jump off the bridge? And, sitting here in Washington, D.C., I think it depends on which candidate you ask. You will get very different answers to that question about whether natural gas is a thing of the past and should be kept in the ground, or is a vital source of energy transition and economics for the coming decades, or is the only viable source in renewable energy should be shut down. So you get a whole wide variety of fairly differentiated views on this topic, which goes along with, I think, the polarization behind politics and energy policy generally in the US, but really worldwide. So you'll know by the end of this transition, by the end of this presentation, where I stand on this issue. But what we'd like to do, and actually along the lines of this logic, we've been doing some updated modeling with our global gas and LNG model, which is an integrated natural gas system model for all the major markets: North America, South America, Europe, Asia, etc., as well as the LNG model. So it's all fully integrated and operational as a market simulation worldwide. And I'm going to show you some results of that. We've done a full update for the impacts of COVID-19 in our new kind of base cases, and we've run some scenarios around carbon pricing and carbon policy, essentially as a proxy for climate policy, to show you what those impacts look like. We've also been working lately on more extreme scenarios like fracking bans. I won't show that today, but suffice it to say, those are pretty extreme results in terms of what those mean for the market. And I can speak to them generally without giving you details or numbers here. So let's go into the agenda. First of all, our lawyers required, we're not providing formal advice or legal advice. So, please perform all your own due diligence on your transactions and take this as a conference presentation, not to be used for making decisions. We have 4 sections. I will cover the first 2, and Roberto will cover the second 2. I'll talk about the market impacts we've seen most recently of COVID-19 and the outlook for the gas and LNG business. Then we'll run and show you a carbon tax scenario. This is a US carbon tax scenario, assuming that sort of a policy gains currency in the next Congress and administration. And then we'll turn to some of the implications and the development of LNG and its role as a bridge fuel in South America and Brazil specifically. So turning to the most recent impacts of COVID-19, I think everyone probably already knows the gas and LNG business was already, due to the advent of shale gas and enormous volumes of low cost, increasingly low cost, abundant shale gas production and US LNG exports, the US market and the world broadly had become oversupplied with gas and LNG to start before we entered 2020. And that's only been compounded by the pandemic and the demand destruction that has caused in most of the major consuming markets of Europe and Asia. In the US, most producers are maintaining output from their existing wells, and that's leading to sustained high gas production over the coming few years. You may know there were a lot of drilled and uncompleted wells. There's a lot of production that had been brought online, and those decline rates for new wells of 1, 2, 3 years, plus the wells that can be fracked and completed with little effort because they're already drilled. are all there and can be brought online at a low kind of incremental or marginal cost. Having said that, this is a business, the shale gas business is one of requiring a lot of rapid drilling to keep production up over, the longer term. And so with low gas prices and limited demand, eventually, not eventually, within a short period of years, that lack of investment will catch up. And we see, the pullback due to oil prices in the liquids rich and associated gas drilling, that's certainly going to take an impact. We see the production shifting over to dry gas, and the dry gas production is more expensive, but not terribly more expensive. I mean, we're talking about 50, 60 cents more expensive on average. The pandemic-induced recession has reduced gas and LNG demand in Asia and Europe moderately, but the ample supply and sustained low prices for gas and LNG are also supporting demand recovery from the pandemic, after the pandemic, I guess I should say. As a marginal source of global LNG supply, the US LNG exports have decreased significantly in 2020, although a measure of recovery is already underway. And I think we've just seen last month, more substantial rebound where the feed gas intake for US LNG is back up from 2-3 BCFD to about 5, whereas it was pushing 9 BCFD before the pandemic. So it's on the way back, but it's not totally back yet. There are several indications of delay or cancellation of investment and financing activity in LNG production until investors and their lenders, I should say, become confident about when the market will rebalance. The market downturn has resulted in a variety of significant FID delays for LNG infrastructure all along the Gulf Coast, as well as internationally. But despite these near-term impacts, the gas and LNG sectors are anticipated to recover more quickly and completely than oil-consuming sectors and industries around the world. Gas being used for power generation, industrial consumption, really in the sectors and areas of economic activity most likely to rebound quickly coming out of the pandemic, as we've already seen evidence of, looks a bit more promising than the oil side of the business, where consumption is concentrated in ground transport, essentially mobility, ground transport, air transport, and marine transportation, which look like they have a harder slog to come back. And if you followed the recent comments of BP, which I think are prescient, we may have already seen peak oil and they may not fully come back. So these questions are on the table for oil. So let's look at what are the production trends and the implications. In our new base case, updated for the COVID pandemic, we see U.S. associated gas production declining, along with lower oil and NGL prices, as you would expect, and a shift toward dry gas. The U.S. gas production recovery and shift yields only moderate increases in Henry Hub. We were expecting to see some bigger jumps, but actually, given the vast resources and also the reasonably low cost after years of learning and scale economies and efficiency improvements, even in the dry gas space, the impact is positive, but it's not enormous. And so you see on you see the price trajectory for Henry Hub on the left side of the graph on the right, and you see how far down it's come with a bounce back recently, already signaling some of these changes. We see that trend continuing and sort of a recovery into the mid 2s to maybe the mid 3s on a seasonal basis for Henry Hub. So we're already at, I forget where it was today, but it's been in the 230 to 250 range. It's already sort of bounced back into that level we think is about right for dry gas production, and it'll firm up a bit more into the mid 2s and the mid 3s. But there's nothing very dramatic here. It's just, if you looked at business as usual before the pandemic, you would see that curve sort of shifted down probably about 50 cents or so, maybe even less. Now let's look at the impact of all these trends on global LNG trade. So these two charts show the west of Suez and the east of Suez supply-demand balance for LNG Of course, on a global basis, everything nets out and supply always equals, supply being production always equals demand, with the differential only of boil off and losses. But when you look on a regional basis, you can see the trends of how trade is evolving. So in the west of Suez market, that's the Atlantic, that would include the U.S. Gulf Coast and so forth, everything from Suez to the west. You see that the market was in a bit of surplus over 2017, really 2018, 19, and then sort of started moving back into balance going into 2020. But we see now with you see that flat demand line, the dotted line, and production continuing. I mean, this is production that's pretty locked in from the projects that are existing or under construction. It will go into a substantial surplus heading toward 2025. Just the inverse pattern in the east of Suez markets, being the Middle East itself, South Asia, Southeast Asia, and East Asia. You see that it was in a bit of deficit in 2018, 2019, which was marginal volumes flowing in from the Atlantic. Those are not big surpluses and deficits. That's a very orderly amount of interregional trade. It doesn't require large arbitrage differentials and so forth. But then you see going out toward 2025 a pretty substantial deficit between regional production, Australia, Qatar, Middle East, Indonesia, and Sakhalin, and regional consumption. So that will then be supplied from the Atlantic basin. So we'll be going back. I don't think this is to the level of the post-Fukushima years where you had these huge flows from the Atlantic into the Pacific basin, but it is headed back toward an Atlantic surplus feeding a Pacific deficit, and that will tend to create some measure of price differentiation between the regional markets. Not enormous, but you'll see that soon. Let me go to the next slide. So here are the prices. As I've said, it's the continued relentless production growth, even just from the inertia or the momentum of all of the projects developed in years past coming online, as well as continued dry shale gas production. The decelerating demand and of course the recent pandemic impacts have plunged natural gas and prices to a rock bottom, and you see that really in 2020. Whereas in the recent years before that, there were peaks, in the $8 to $10 region for LNG. We're now down into a very tight range for all LNG prices in the $2 to $3, maybe $4 range. These are spot prices for JKM TTF as a proxy for LNG into Western Europe, and of course U.S. Gulf Coast FOB prices for U.S. LNG. Looking forward, the delay and destruction of new liquefaction projects and the gradual demand recovery, and as you saw in the demand charts in prior slides, the demand recovery is meaningful, but it's not enormous. We see, actually, let me just go back quickly. You see these sort of much more flat lines than we're used to. If you look at the demand in the Atlantic basin, you still see the growth in the Asian market and so forth. So it's a moderate demand view, still overpowered by substantial supply coming online. And as a result, the U.S. LNG deliveries, as a result, of these trends, you get moderate price recovery, which you see on the right, with prices on a seasonal basis, depending on whether it's U.S., European, or Asian, kind of in the low mid-3 range up to $5-6. You see the regional differentiation, but still a fairly tight range, and the seasonal patterns. As a result, U.S. LNG deliveries to Brazil might cost, taking the U.S. FOB price and building it up with liquefaction costs and shipping, might cost in a range of $5 to $7 per MMBTU. But that's just U.S. deliveries, and actually traded market values can be lower in periods of surplus and supply competition, or higher in tight periods, or for example, winter, depending on trends in the market. So that's sort of a cost-based view, but a market view, coming from the model, can be different on a given period of time. Okay, so let's look, that gives you kind of the baseline. Let's look at the outlook for a US carbon tax. We're assuming a Biden victory, of course, in thinking about this, but I don't want to focus exclusively on that, although that may be the likely scenario now. It's not a foregone conclusion. And we also have, very importantly, I think, outside the United States, people tend to forget about the importance of the constellation in the US Senate and in the Congress. And there's a lot of signs of substantial change. We don't know how much yet, of course, in the constellation of uh, seats, both in the Senate and the House. And there is really, I don't have the polling numbers here, but a very substantial, solid, and sustained public opinion in favor of climate change policy, carbon tax, and so forth. So we don't know what will come out of the elections, but we do know that, on that one issue at least, voters are unanimously, and I've seen polling in the range of 60 to 80% in favor of, substantial climate change policies, green energy stimulus, and/or carbon tax kind of policies. So there's a pretty good chance that this will start moving one way or another. I think the questions are really more how much and how much and how fast. So one policy scenario would feature implementation of a carbon tax to mitigate climate change, and we're focusing here for this scenario on the Energy Innovation and Carbon Dividend Act that's gained traction amongst policymakers on both sides of the aisle in recent years. And on this basis, we assume carbon tax would be implemented in 2022 after debate in 2021, starting at $25 a metric ton of carbon and increasing by $10 a year, reaching 55 by the end of the horizon we're showing here in 2025, but eventually climbing to $100 per metric ton over a longer term. And there you see the numbers in the chart. So that's the baseline assumption we're factoring in to the gas and power market operations in the model. So here's what happens to US LNG exports as a function of increasing Henry Hub prices and the impacts on supply and price in the North American market. US exports decline in the near term by 13 to 19 BCM, or about 1.3 to 2.0 BCFD during the first few years of policy implementation, but then the impacts are less after that because the tax becomes more detrimental to coal-fired generation and therefore boosts gas-fired generation. So there's a lot of interesting timing impacts of immediate impacts on gas demand, but then increasingly impacts on coal, increase of gas demand, and then eventually, if you look in the longer horizon, renewables overtakes both of them, and the impacts are even more substantial on gas downward. So it's a very interesting kind of year by year story that emerges over the next decade. The result of the higher gas prices makes LNG exports less economic in the near term, less competitive essentially. But these impacts moderate as renewable energy catches up and lightens the demand pressure on natural gas. So you see pretty meaningful impacts on LNG exports. But interestingly, even with that, turning to the next slide, the impacts on LNG prices, given the vast supplies and liquidity in the LNG market over this time horizon, are really, although you see bars and numbers, these are very small numbers. Don't let the scale of the chart be deceiving. I mean, we're talking about pennies, less than a nickel in any given year, in any given price from the reduced US LNG supply. So the impacts are not substantial. And again, this is a testament to how far the LNG industry has come in building up supply diversity, supply flexibility, and liquidity of trade, that the market kind of corrects or manages, changes in supply from one source with supply from another source. So these are very moderate impacts. They increase a bit. First they're negative, but then they increase a bit for a few years before they just, revert back and kind of compensate. So really strikingly limited impacts on LNG prices from such a scenario in US policy. And with that, let me hand it over to Roberto to talk about what some of the implications are in South America and Brazil. Roberto?
Thank you, Chris. Hello, everyone. It's very nice to be with you again, this time with BRG, for those of you that knew me from my prior employment. And I will take the discussion from here to discuss what does it mean for LNG in South America and for natural gas markets in this region at a larger context. And later on, because of what I will conclude in this section about South America, we will take a closer look at Brazil. I promise it's not because I'm based here or that because I'm Brazilian. It is a natural follow-up from the context of LNG in South America. I would like to first take a step back, like just to re-emphasize or set the context with the story of LNG in South America. Why South America consumes LNG, how did that come to be, and what is the role of LNG in this region? If we go far back, but not too far back, just in the beginning of the 2000s, LNG was a very shy actor in the regional gas market. We had exports from Peru and from Trinidad that were discussed and implemented between the late 90s and early 2000s. And those were mostly project financed, very vertically integrated and well tied into long-term contracts kind of projects. And elsewhere in the region, the actual market that we had there was mostly well supplied by the regional supplies. So we had the more mature Argentine market from the 50s that liberalized in the 90s, exporting to almost all of its neighbors. We had the Brazil and Bolivia entering into a long-term supply contract in the late 90s. And that was really it. There was no need and no role for LNG, especially as imports, as a source of supply for the region. Now, as the decade moved on, the picture began to change, and by the 2010, by the early 2010s, we had strikingly different pictures. We had nothing less than 8 regas terminals built in what was unanticipated 10 years before. It wasn't on the map that the region was going to need those many regas terminals in such a short period of time. And the main reason was hurdles for continuing to develop the regional supply projects. We had most notably Argentina that went through its macroeconomic crisis of 2001 to 2003. As a result, there was different energy policies in the country leading to policies that didn't favor new investments in the upstream. Argentina was happy at the time and comfortable with its reserve base, but did not have any spare capacity anymore to export to neighbors. So hence you see the red arrows in the map, which are pipelines that were built in the 1990s and 2000s and later on became idle for almost 10, 15 years. Some of those only started to be used again just some 5 years ago or less. So at least for the southern cone, the strict southern cone, Argentina and Chile, the role of LNG at that time was to fill this gap, to bring LNG in Argentina in the winter, to substitute Argentine gas in Chile. So sort of a base load, if I borrow the term from the power sector, source of supply. And the other 2 countries that have regas terminals are Colombia and Brazil. These 2 actors came to LNG for a different reason. Those are more on the tropical side of the countries. They don't have the winter demand, the space heating demand, and they required LNG as a backup for gas-fired power generation for their hydro-based power systems. So both Colombia and Brazil rely predominantly on hydropowers with reservoirs for dispatching power, and occasionally the rain levels may not be sufficient to sustain power generation from hydro. So these countries build thermal power plants in general and increasingly gas-fired power plants to stand by and to be there for dispatch in case the rain levels are insufficient. And what this means is for the gas supplies sector around these gas-fired plants, this translates into a highly variable dispatch pattern, which requires a very high flexibility on the gas supply system. So both Brazil and Argentina found on regas terminals the cheapest source of flexible supplies. You only build the regas terminal, you lease the FSRU, and when needed, you can bring a spot cargo or you can bring the actual gas supply for the power plant. So the systems in both countries, more in Brazil, but to a certain extent also with the Cartagena terminal in Colombia, they exist in mostly to be there and to be called upon when the power plants have a very high dispatch level. And where are we now? 10 years later, we see diverging patterns for the countries that relied on LNG in the 2010s for winter demand and for sort of the base load kind of gas supply that I alluded to. And Colombia and Brazil are the countries that will see a reinforcement of the need for LNG over the next 10 years. So those are so starting with Argentina, with developments in Vaca Muerta and the unconventional revolution in Argentina, we're in a new situation where there is supplies, where it's no longer an issue, but considering the shorter life cycle of wells that Chris alluded to in the US, Argentina also needs a constant flow of investments in drilling in Vaca Muerta. So you need a predictable price. And there's also the need to make the production from Vaca Muerta year-round, not just focused during the winter for imports. And when you do that, you kind of want to export during the austral summer. That allows you to produce more and bring that extra production from the summer into the winter and avoid LNG imports. So Chile and Argentina are two countries that are trying to run away from LNG as the most expensive source of gas for them and trying to replace that to the extent possible, taking into account supply security risks for Chile, swap gas with Argentina and LNG, trying to just make the best deal you can, optimize the infrastructure that's already there and pay less for gas, but not expose yourself to curtailments from Argentina again. Argentina is trying to produce more Vaca Muerta gas in the winter, and as a result, bring it in the summer and bring it into the winter, and therefore trying to reduce the LNG imports in the winter as well. And that brings these two countries to no longer need more LNG regas terminals. They are happy with the two that they have. The Octopus project in Chile has been postponed, given the favorable results of wind and solar in their power auctions. So the trend, for at least for this decade, is pretty settled in Chile and Argentina, absent a major reversion of globally of trends. These countries are well set with their 4 regas terminals. Now the picture is different for Brazil and Colombia as well. Colombia discusses a second regas terminal on the Pacific coast for this decade. And Brazil has just early this decade and late last decade added 2 more terminals, private this time, no longer pioneered by Petrobras, one in Sergipe and another one in the state of Rio. And these terminals are reinforcing the role of gas as a backup, the role of LNG as the flexible source of gas for power plants. Both projects are associated with new CCGTs. In Sergipe, the Celsi power plant, and in Rio de Janeiro from the Asupart, the GNA power plant project. So that's why the future of LNG and the discussion around the role of gas in the energy transition in South America will be focused in Brazil first, as the largest country requiring LNG imports in the future, but to a certain extent Colombia as well, that also has this hydro-based power system in a smaller scale than Brazil. So let's discuss a bit Brazil, which will.
Hey, Roberto, do you mind if I jump in? Sorry, but we got some good stuff going in the chat here. Could you back up one slide? I think it's important that we do this now. just clarify, there's some discussion in the chat here about the number of regas terminals in Argentina. There's discussion over, is it 1 or 2 terminals? Can you just clarify that with your information here?
I'm alluding to Bahia Blanca and Escobar terminals. One of the FSRUs may have been released recently, but the docks are still there. So to wrap up the section, we will see then how the region has evolved over the 2000s and the number of LNG projects. Brazil has over 10 in study right now, candidates for power generation projects. And as we move on, we would like to focus on Brazil for the remainder of the discussion, for the importance and the ability to give a role for LNG and an answer for the energy transition. So Brazil, the role of gas that I discussed for LNG in Brazil is the role of providing backup for gas-fired generation. And how is that working right now, and where is that going forward? So let's first take a look at the power mix of Brazil. On the dark blue area, we see the hydro capacity. So we see the amount of hydro and the share that it takes. And on the light blue, we see the increasing penetration of renewables in Brazil. So just in the 20 years ago, again, in the 2000s, Brazil almost did not have any renewable generation capacity. And just over the past 10 years, we see it is gaining a lot of traction. And that we see as well that natural gas has been growing on the sides, and also taking a bit of share from the other, which includes coal, nuclear, biomass, and the remaining sources. Going forward, what we're seeing in Brazil is, and this is a stylized chart, it's not a full detailed scenario, it's just to illustrate the main trends. But we see hydro in Brazil as stagnating due to the absence of new sites available for very large hydro projects, such as Belo Monte. So indicatively here, the graph freezes hydro where it is. Of course, in reality, in a more detailed scenario, there's room for punctual hydro projects between now and 2040 in Brazil, but this is just for an exercise. And what we see as a trend, especially fueled by the energy transition, is the ability to continue to grow the renewable penetration in Brazil. So wind and solar have already been performing very aggressively in power auctions, and costs keep coming down. We see a wave of projects under developments for solar farms, both on the distributed generation scale and on the utility scale. And we expect that renewables in Brazil will eventually become the size of hydro, maybe in the long term. And most importantly, the portion of the Brazilian grid that will continue to be intermittent or requiring backup would continue to increase. So there is still a role for thermal power generation in Brazil in providing backup for whether it be it hydro generation or whether it is for a combination of hydro generation, wind, and solar. So at least for the initial 10 years, until we can expect a disruptive technology on the power side in batteries or a reversion of the mix, we could be comfortably working with more gas-fired power plants. And that's a trend we already see with the projects that recently won contracts in association with LNG projects. But if that trend were to continue uninterrupted for 20 years, the amount of, and all these thermal plants materialize as gas-fired power plants, Brazil would require up to 20 gigawatts in new thermal CCGTs with a variable dispatch profile. So once again, having LNG as the cheapest source due to the flexibility. So I think I got a bit ahead of my time, but to show the point that if we look at the shares of the mix, we would see the light blue section pretty much compensating for the decline in share of hydro, and we see gas taking slightly share from other thermal power generation technologies by being the one that gets added at the margin. And that's where gas could increase from a 9% to a 15% share, and therefore reach a higher need for gas in Brazil. That would materialize through the power auctions, the way they are specified, and the way the projects that line up for contracts win and therefore get built. So to confirm, LNG, as Chris mentioned, has a projected long-term fundamental price in Brazil between $5 and $7, at least for the next 5 years. This may not be the lowest price of gas that you see in Brazil. You could import gas from Bolivia that's presumably under a lower break-even. So depending on market conditions, you could get that for a lower price. You could probably source gas from producers in Brazil for a lower price than $5. Now, why would LNG then be the source of gas for the plants? And it ties once again to this argument of flexibility. For connecting an associated gas field, for example, in Brazil, to a power plant requires a dispatch that takes place every day. If you're trying to produce oil in association with gas, you want to take the oil out every day, and you need the gas going out every day. So if the power plant is not on every day, or you would have to somehow shut in that gas or leave the transfer routes, the liquids plant, sitting idle because the gas-fired plants are not consuming gas, this sunk cost, this capital cost of this infrastructure makes monetized on just the period of time the plants actually pay for gas would be much higher than LNG. And hence comes the ability of LNG to contribute to Brazil. Because LNG is just the regas terminal, sometimes just the dock and the LNG arms that connect the terminal to the shore. Even the FSRU is leased. So you bring the FSRU, you can release the FSRU as Argentina, as Brazil did as well in Guanabara Bay. When you know, like for the next 4 or 5 years, the reservoirs are really full. It would take a very unlikely outcome of rain levels for those reservoirs to be exposed once again. You may even release your FSRU. You could just bring it back in 5 years' time once the hydro reservoirs are really back down. So this is an important final thought for this presentation. Brazil needs, and South America will continue to need LNG import capacity. First. So by adding LNG terminals does not immediately translate in an LNG base load sort of a long-term contract import level. These volumes can be swapped into the LNG market for domestic volumes in case that's profitable. And in this case, it wouldn't show on the Brazilian LNG import statistics a level of imports. And what Brazil really needs, and Colombia, is the ability to import gas. So as you add new CCGTs, you add more regas terminals to have supply coverage. In case a full dispatch takes place or a drought, so as sort of a supply security. That is to answer your question, Jerry, from the beginning. Does natural gas remain the transition fuel? In this story that I'm telling here, gas remains the transition fuel because it allows the highest possible penetration of wind and solar in Brazil. Gas is, even if it's 20 gigawatts in Brazil or anywhere between 10 and 20, it is taking place to the extent needed to allow the supply security of the Brazilian power grid as it continues to add wind and solar. So it is sort of a residual role for gas, which translates into a role for LNG. But the imports would only take place to the extent the wind and solar and hydro are not performing, and therefore requiring the backup from gas and LNG. So there is a role. It is still a role as a bridge fuel. It is solid for this decade. For the 2030s onwards, it's more as a trend or as an indication. It requires that many of the signposts don't materialize, such as batteries. So for the 2030s onwards, it could take different directions. But for this decade, gas has still a solid role in the region. Thank you very much.
Thank you, Roberto. Thanks for letting me jump in there earlier, and thank you, Chris. Let's okay. Let me quickly remind folks. And thanks everyone for jumping in. We had a robust discussion about Argentina's LNG regas capabilities, or the number of infrastructure installations in existence. Here's our friendly reminder. This is the Madrid Energy Conference curtain raiser talking about LNG and natural gas. Join us online for the virtual Madrid Energy Conference, and I posted. Also in the chat function, the link to that. And so post your questions there. Let me start. And by the way, thanks for telegraphing my wrap up yes or no question. Everyone who comes to La Jolla and dials into our webinars knows I always like to wrap up with a yes or no question. So we'll come back to that and follow up with both you and Chris. But let me pose this to you, Roberto, to kick off our conversation. We ended on Brazil. And there's been the last year or so a major policy development in Brazil with regards to natural gas and the model in Brazil for lack of a better word, further liberalization of the natural gas sector and market. My understanding is it's in between houses of Congress for final approval. Can you give us just a 30-second to a minute update on Brazil's natural gas policy environment?
Certainly. This is a very exciting moment for Brazil after almost 11 years since the current gas law of Brazil from 2009, and probably over 5 to 7 years of debates around how to reform that law. The Chamber of Representatives in Brazil voted just last week or the week before and approved the PL 6407. Which is will be the new gas law of Brazil. It's now going to the Senate, so there needs to be the approval of the second house, and then for presidential sanction. But these two steps are considered less challenging than the Chamber of Representatives. So it's where the project began, and it's where you need to get over 500 representatives to agree, and where you can measure the temperature of the political forces and the political balances more accurately. So if the coalition bloc manages to approve in the House of Representatives, it signals a high likelihood of approval in the Senate and sanctioning.
It's very, I mean, that ties directly back to some comments Chris made about, watching the U.S. election, and not just presidential level, but Senate and House races and what the composition of Congress. So distinct but similar. Sorry, Chris, let me follow up really quickly with Roberto, because we've got a question here from Sebastian about how much does it cost megawatt hour generated at $5 to $7 million MBTU of LNG in Brazil. Could you talk a little bit about that, the cost question? And I know, Chris, I want to come back to you on price, because I think it's an important broader concept, but maybe Roberto, specific to Brazil and LNG in generation costs.
Yes.
Jeremy?
Yeah.
Sorry, Roberto, before that, I just want to emphasize one point, because I saw that question, and I want to re-emphasize what I said, that those are cost buildup numbers that make a few key assumptions.
Okay.
The 5 would be more like a summer price. The 7 would be more like a winter price. So there's sort of peak seasonality in there. Consider what Roberto said, and the season in which Brazil needs LNG is more likely to be off peak from the northern hemisphere. Second, as costs build up, as we know, when LNG is in surplus, there's a lot of price pressure, and so supply costs don't matter. Liquefaction costs, capital costs are not fully recovered. Traders optimize portfolios, and supply can be delivered below a full cost buildup. So, and the last thing I want to say, and I'll talk about separately later, it's too complicated right now, but is the difference between long and short-term markets for LNG. Mm-hmm. Yeah. And so I just want to caution, I think Roberto should answer the question, but that those are hypothetical cost buildup numbers, and I would not suggest to the audience here that those are the actual numbers that one could negotiate, for example, in a long-term contract for LNG, which it would be a new thing in Brazil. Brazil only buys short-term. So just with that caveat, think about the answer in terms of the megawatt hour cost of generation with that caveat.
It's an important distinction, and we'll come back to that because I wanted to ask you about the contract, where we are today with sort of, short versus long-term contracts for LNG, because that's evolved a lot in the last year or so. But okay, Roberto, over to you. Thanks.
Yeah, I think it's for this audience is more relevant to discuss the fundamentals, like behind the price than the numbers, because numbers require a more in-depth conversation. I'm happy to follow up with whoever asked for a specific number by email or over a phone call. But fundamentally in Brazil, what you're seeing is that gas from LNG has been competitive on the power auctions, but under some very detailed circumstances. Like these recent projects, the one contracts, they are actually tied to long-term LNG contracts, and they had a very aggressive maneuvers in terms of the flexibility profile of the plants. So I mentioned in my presentation, Brazil needs flexible power plants. It needs power plants that are almost 100% available for a dispatch at notice. And what these plants, the one contracts for now did was sort of a tug of war between the conditions they require with the LNG suppliers and the conditions they can get from the Brazilian power sector. So the Brazilian power sector allowed 50% of inflexibility, and for the first time a few years ago, began to allow the project to choose when that flexibility would take place. So if that would be for a full semester, and then you are flexible in the second semester, or if it's 50% every day, year-round, for 50% of your capacity, and the remainder is available for to be called. And what this project managed to do to be competitive in the auctions was to allocate the inflexibility during the times they expected to be dispatched the least. So with this, like they when they were probably going to be idle, they are inflexible, and therefore they generate and they bring the LNG. And on the rest of the time, it's likely or very likely they will also dispatch because of the season of the year and the expected spot prices for that time. So they are trying to get to an inflexibility, or they call it a probabilistic inflexibility that's very high, which allows you to buy a long-term LNG contract and only have to divert cargoes to the spot market at a minimum. Going forward, fundamentally, Brazil needs flexible cargoes, so flexible plants that will probably bring spot cargoes or some kind of a very flexible LNG supply arrangement. And that will tie into the new law that got approved. It will tie into having a more dynamic transportation grid, having the ability to be able to pay entry-exit tariffs and optimize the economics of these transactions on the short term, so that these plants don't need to have a long-term contract and that commitment for a dispatch that will take place occasionally.
Thanks, Roberto. And I want to come back on a question about Colombia. You detailed somebody's question on Brazil, but I want to take some of that same information and maybe extrapolate it to what you see in Colombia. But first, Chris, I think the word flexibility in LNG contracts was certainly not something we never heard the word flexibility in LNG contracts when you and I probably first met, right? And when Roberto put up on the slide, Peru and TNT is the only LNG players. So where are we today in terms of contracts, which of course has a lot of relevance to your distinction on price, right?
Well, I mean, this is a great discussion because it is, in fact, the U.S. LNG that has, substantially amped up the volume of flexibility available in the market. And it is sort of famous for providing commercial flexibility insofar as the tolling model or even the SPA model, the way in which those cargoes are sold, U.S. producers, as long as you pay one way or another through tolling or through a take or pay and a capacity payment embedded in SPA, as long as that liquefaction cost is covered by somebody, a marketer, an aggregator, an off-taker, you can cancel the cargo, which we've seen over the last several months. I mean, almost huge numbers of cargoes canceled during the pandemic. That's, there's a cost, but it's only the cost of the liquefaction. It's not the cost of the whole supply chain, including the production and the commodity. So that's a great deal more of lower cost kind of flexibility available in the market, one way or another, through all of that supply. And that's been putting a lot of pressure in this oversupplied market, highly competitive LNG market that we've been in, putting a lot of pressure on other producers to, when they have a contract expire in the Middle East or, Southeast Asia, and they need to, resell a certain amount of volume, to resell it shorter term, more flexibly. You've got a lot of terminals around the world that are now more amortized, paid off, debts under control or paid off, where they can afford more flexibility. And the market has been moving very quickly in terms of, renegotiating price and flexibility to, better serve buyer and seller kind of needs and interests, renegotiate them. That's been an ongoing trend before the pandemic, and it's only increasing now in terms of the perceived need of flexibility given the uncertainties in the world. So I think that's good news for Brazil in terms of the flexibility it needs. And as Roberto said, it's not just the commercial flexibility in contracts in terms of their term, their flexibility provisions, or the nature of the contract itself, but also the fact of using FSRUs, which are inherently, as compared to a landed regas terminal as a 25-year kind of fixed investment, inherently flexible, because you can shut them down and sail them off if you have a sea change in the domestic gas business and no longer require the infrastructure.
No, again, it dates us a bit, but I think about when you probably first presented on this topic at the Institute of the Americas in La Jolla, how much has changed. It's quite remarkable. It's quite remarkable.
It's a whole new world. Let me add just one last thing, Jeremy.
Yeah, we're running out of time, so I want to be sure Roberto comments on Colombia and Argentina, and then I've got a question for both of you to wrap up.
Okay, I'll be brief. On the question before about the cost of power generation, I think I just want to emphasize it's too much to deal with on a short webinar like this, but there is a very big difference between the nature, not just the flexibility, but also the pricing of LNG under a committed term contract and a spot market contract. It's not yet the case that the two are essentially the same thing because of pricing index to hub. There is a difference, and it's a negotiable difference. And it's something that moves around a lot with geography and time, based on how parties negotiate these interests. So it's a much more complicated problem than just saying U.S. Henry Hub plus some number gives you the price in Brazil. It's a highly negotiated, flexible kind of situation.
Well, good news for consultants like you and Roberto, I guess.
Tends to be. I'll leave it there.
Thank you, Chris. Indeed, and by the way, this is a curtain raiser, so we can perhaps tease some of this, more of this out on the panel on October 1st. So, Roberto, just quickly, there was a question about what similar to Brazil, is Colombia using spot market LNG purchases to offset the sort of hydro swings in the power market, and then any thoughts? Give a 30-second summary on where Argentina is today. Not so much on regas, but the last administration with Vaca Muerta had enormous plans for plugging Argentina into the global export business for LNG. So there you go. Two things. You got 1 minute. Fire away.
Colombia, I need to get back to you on this question to revisit the contracts, see if anything changed. So let me go straight to Argentina. Argentina recently implemented Plan Gas 4, which is a very interesting update. It means that the new administration of Alberto Fernandes is going to maintain sort of the broad approach of introducing a target price for producers, now lower than before at $3.50 per million BTU, and keep maintaining the tight balance of freezing prices to end users and using the government to pay the difference of those frozen prices and the target price. So this is a very pragmatic approach for this administration, and we thought that was going to happen from the beginning, because right now is a different picture than what was when freezings began, like in the Kirchner administration in the 2000s. Argentina no longer has that reserve base for some 5-10 years that it did. And right now, if the investments don't continue to take place in drilling in Vaca Muerta, then in a few years you won't have it. So you need the conditions in place for drillings to continue to take place, and for even expanding pipelines to offload gas from Vaca Muerta as the other basins of Argentina decline. There's going to be a concentration of supplies in Neuquén, and eventually the offloading capacity out of Neuquén will not be sufficient to take all that gas to Buenos Aires. So we also saw this first semester, again, discussions on the expansion of pipelines out of Neuquén towards Buenos Aires. And that even tied into a discussion about bringing revamping the project of the Uruguaiana-Porto Alegre line in Brazil. So sort of making this new pipeline in a way that it continues all the way up to Brazil, and it could even show up in Porto Alegre with Argentine gas competing with pre-salt gas and Bolivian gas in the future. So these are very interesting developments for the next 4 years. The Plan Gas 4 is a major update in the region for Argentina as it affects the regional market. And overall, the possibility of the LNG exports for Argentina, it's a bit on halt for now. But the idea was the same as exporting back to the neighbors: create an outlet using the Bahia Blanca facility to have a vessel that liquefies gas, so you can sell it during the austral summer, which is the boreal winter, right? So when LNG prices are higher, creating demand during a season that allows Vaca Muerta gas to be produced during the Argentine winter. So very interesting developments in Argentina, which affects the entire region.
No, thank you. In fact, the Argentine development's probably the own webinar, like you said, Plan Gas 4, the continued debate over what to do about infrastructure to evacuate, the proposed increases in production. But to Chris's point on the broader shale and in unconventional, Argentina cannot pause drilling too much because you will have a major down.
Exactly.
So thank you. Look, I want to thank Chris Gonçalves and Roberto Cunha from BRG. We greatly appreciate your participation and sharing all these insights. We could go on forever, but people have to run, and we're already past the hour. So again, on the screen is the Madrid Energy Conference. You'll hear more from Chris, and we look forward to that. So let's wrap up. Here's the yes or no question, and I'll ask for a one-word answer along. So the yes or no question, which I think we've already with your answers, but let's just do this because I like yes or no's. Does natural gas remain the transition fuel? Chris?
Yes.
Roberto?
Yes. For this decade, for sure.
So yeah, you both telegraphed those answers nicely in the deck presentation. So then, what is the key issue in word to ensure that it does remain the transition fuel? One word. What is the key issue, Chris?
One word.
Well, you can get through.
I'm going to give you a few sentences. To me, the issue, you didn't ask the yes or no question based on timing. And I would say the question is, for how long does it remain the transition fuel? That's obviously scenario driven, but it's not many decades anymore, in my view. I think we're getting down to 1 to 2 decades in terms of its role as a large scale transition fuel before it starts to go into decline.
Perfect. All right, Roberto, you can't choose timing. You have to choose a different.
Yeah, no. To me, it's the ability to allow increased renewable generation. This is the
complementarity.
The complementarity. So to the extent you're adding gas-fired additions and you're consuming gas to allow the energy transition, this is a good bridge fuel.
There we go. Well, like I said, we'll have much more, another hour on this topic at the Madrid Energy Conference. And by the way, we'll talk about a lot of these other issues that were brought up today as well. I mean, the role of a carbon, the role of climate action, obviously hugely important as part of the Madrid Energy Conference agenda. Everyone, appreciate everyone who joined us today on the webinar. Stay tuned, more to our partners, IPD Latin America and Global Event Partners, for working together with us to pivot and bring the Madrid Energy Conference online this year, September 28th to October 2nd. See you all again very soon online here. Thanks, Chris. Thanks, Roberto.
Thanks, Jeremy.
Have a great day.
Bye-bye, everyone.
Thank you. Bye-bye.